Trend lines. The next concept we will discuss are trend lines. Trend lines are another very important tool of technical analysis, and specifically charting. The purpose of a trend line is to identify particular uptrends or downtrends. Let's start with an uptrend line. What is an uptrend line? An uptrend line is a straight line drawn upward to the right along consecutive lows. Right? So if the lows keep getting bigger, keep getting higher, and we draw a line to signify that, then that is an uptrend line. Now we will go back and look at the example in a couple of slides to see how it works. But first let's think about it conceptually. So we have a series of lows that keep getting higher, and we draw a line along these lows, and that becomes our uptrend line. Likewise, with a downtrend line, it's the same thing, but of course in the opposite direction. A downtrend line is a straight line drawn downward to the right along consecutive highs. If we see that highs are getting lower and lower, right, so the peaks are falling over time, then obviously the price is in a downtrend. And we can then draw this downtrend line along these peaks, and this becomes our downtrend line. Now in order to draw a trend line, we need to have a couple of points in place. Right? So let's take the example. Let's say we want to draw an uptrend line. To do this, we need at least 2 consecutive lows, with the second low higher than the first. So we need 2 points at least to draw a trend line. Right? And the vice versa will be the case for a downtrend line. We need at least 2 consecutive highs, with the second one lower than the first, for a downtrend line. Now while we can draw a trend line with just 2 points, in order to confirm the validity of the trend line, we need prices to bounce off it a third time. So we actually really need 3 points to confirm that an uptrend or downtrend is taking place. So we can draw a line with 2 points, and that will be a tentative trend line, okay? But a definite trend line, right, to confirm that it's valid, we need to have a third point bounce off of it. And essentially, the more points bounce off that trend line, the more valid it becomes, but we should generally have at least 3. Trend lines. Let's now continue our discussion on trend lines. Now that we know what a trend line is and how to create one, let's talk about why they're useful and why they're important. A trend line can be used to identify support or resistance and corresponding buy or sell opportunities. So when a price bounces off a trend line, let's say we have an uptrend line, so the trend line is below the prices, and prices are hitting it and bouncing off of it. Well, that can be used, that's for example a support, right? Because prices are bouncing off of it, there's buying pressure, they're going back up. Then we can use that to create a trading opportunity, right? That can be a buy signal. Right, so we can use trend lines to find buy and sell signals by identifying support and resistance. The other thing a trend line is very useful for is to identify when the trend has changed. If we have a particular trend in place, let's say an uptrend, then when that trend line is broken, let's say when the price breaks through that trend line, that can signify a change in the trend. So much like with support and resistance, right? When the price breaks through a support, that's significant, that's indication of downtrend. When it breaks through a resistance, it's an indication of an uptrend. So the same way, if we break a trend line, we can identify a change in the trend. Now here we have another point which I mentioned before in the last slide, but I would like to talk about it a bit more. So as we mentioned, we needed 3 points to confirm the validity of a trend line. And in general, the following principle will apply. The longer a trend line has been in place, the stronger and more valid it is. Right? So a trend line that has had many times the price bouncing off of it will be more valid and stronger than a trend line that has only had 1 or 2 or 3 points off of it. So that creates a stronger trend line. And the other significant thing is that the longer is the trend line, the more significant the break will be. So if we have a very strong, solid trend line that's been reconfirmed over time, when it does break, if and when it does break, that becomes even more significant, right? That can highly, more clearly signify a change in trend. Now, one of the other tools we can use with trend lines is to apply bands. So if we're talking about breaking a trend line, we can, for example, apply a band to the break, right? So we can say that the price doesn't necessarily need to just cross the trend line, but it needs to cross it by more than X%. So for example, 1%, right? And this is done to avoid whipsaw. And we've talked about whipsaw before. So if the price, for example, is moving fairly close to the trend line and it's kind of going up and down through it, that doesn't necessarily constitute a good signal, right? So in order to see the trend line break, we may want to see the price move at least a certain percentage away from the trend line in order to identify a break. Trend lines. So here we are back to our example. Again, it's the same stock and the same chart as before. And what we want to do is see if we can identify a trend line somewhere. Now we know that the primary trend here is downwards. So any trend we identify is likely to be a downward trend. Though we may be able to identify some intermediate uptrends as well. So a downward trend, if we look at starting here all the way down, we can actually see it fairly clearly, right? So I can draw a line, for example, from here that goes here. It's kind of steadily downwards, and we can see that it is roughly accurate, right? Now obviously that's not a completely straight line because I've drawn it with my hand, but you can also draw this with a ruler and to make it more straight. But what we can see here is that this trend line is kind of valid because it's a slow and steady downtrend, and the price sort of continues to hit it and then bounce off it and fall again. And it does that throughout the course of the graph. Right, so here we have a downtrend line, and then every time, for example, a trend line will be hit, so at this point, for example, when the trend line is reached, this would be a chance to sell, right? And then it would fall here, and of course the overall fall is making us money. Right, so this is how we can use trend lines to identify trading opportunities. So let's see if there are any more. Well, there might be some uptrends we can identify. So for example, if we have, let's say, the price going up here, maybe we can identify this as an uptrend here, right? It gets broken fairly quickly because it would get broken over here. So these are kind of smaller trends we can identify. Trend lines are not necessarily that useful for these smaller trends, but when we're looking at the big picture, then it can be quite useful. So in this case, because the trend has been hit, we have at least 4 points, 4 parts of the trend that hit this line and come back down. It's therefore a fairly strong trend line, strong indication of downward movement in this price series. Okay, so this concludes now our discussion on trend lines. Let's carry on to the next concept. Channel lines. The next concept we will talk about is what is known as a channel line. The channel line is another tool we can use to identify trends and to identify trading opportunities. It is essentially a variation of the trend line. So what we do is that in addition to the trend line, so firstly, in order to create the channel line, we actually need to draw the trend line like we discussed before. So we draw this trend line, and then we draw another parallel channel line. And the channel refers to the fact that whatever's in between those two lines is like the channel where the price should be. So if we have an uptrend line, alright, so remember the uptrend line will be lows getting higher and higher, so the trend line will be below the prices. Then we can draw a channel line above the prices, parallel to the trend line, and that should represent the upper bound for prices. Right? So prices will move within that band, within that channel. And likewise, for a down trend line, because the trend line will be then above the prices, the channel line will be below the prices. And this will represent the lower bound for prices in a downtrend line. This, of course, is fairly self-explanatory and makes sense. Why are channel lines useful? Well, one, we can use them for short-term profit taking. So, for example, if, let's say we have an up channel, right, a trend line and an up channel line going up, we know when the price hits the trend line, that's a buying opportunity, right? Because it should bounce off the trend line and go back up. But if it continues up and then hits the channel line, because that represents the upper bound for prices, that becomes a short-term profit-taking opportunity. And that's why we can use channel lines. Now, of course, just like trend lines, channel lines can be broken. If a channel line is broken, that would signal the acceleration of an existing trend. So, for example, if we have an uptrend, we have the channel line and the trend line. If prices are moving up at a certain rate, they'll stay within that channel. But let's say they start going up even faster, then it will probably break the channel line, right? And that break of the channel line can signal an acceleration of the existing trend. And the same thing will happen going downwards as well. So let's now go to the example and see what it looks like. Back to our example here of the Nifty index over the course of 2011. What we will do now is draw the same trend line we drew before, and this time also draw a channel line. See if we can learn anything about it. So the trend line, I'm going to draw the same one before, starting here. So it kind of went this way. Steady downtrend. Okay, that's our trend line. So let me just write this down here. Okay, and now I am also going to draw the channel line, and I'll maybe do that in a dashed form so that it's easier to see. So the channel line will represent the lower bound for prices. So if we look at where the lows are being made, it will probably be these points here, and this would be parallel to the trend line. And as we can see, if we draw this channel line, now we can see we've drawn this channel line parallel to the trend line. Okay, it's roughly parallel. Please pardon my drawings. I suggest sometimes doing chart analysis. It can be good to print out the chart and do it on paper so that you can use a ruler easily. But in this case, obviously we're going to use the tools we have. So now we have a parallel channel line and trend line, and we can see that the prices never really leave that channel, right? So I drew a line parallel to the trend line to encompass the lower bound for prices, and as a result, the price is fitting in this channel. So then we use this channel line for short-term profit taking, right? So let's say, for example, we were to take a short here because we're at the top of the trend line. We come down here, this is a chance for profit taking because now we're at the bottom and we've reached the channel line. We come back up here, right? This is a chance for a short. Price is going down. It comes again here pretty close to the channel line. This would be a chance to take profits, and so on. So this is what we would use the combination of the channel line and the trend line for. Retracements. The final concept we will talk about in this lecture is what is known as a retracement. A retracement is essentially a reversal of a prior move. Now this is directly related to when we talked about the intermediate trend, right? So if there's a primary trend going in one direction, and after that price move, prices will often retrace a portion of the move. Okay, and that's the intermediate trend. And they will do this before moving back in the direction of the original trend. right? And then when this occurs, we have a retracement. Now in Dow theory, we talked about the 50% retracement. This is one of the common ones that are occurred. So a 50% retracement means that half the move is retraced or reversed, right? So if the price moves from 100 to 200, a 50% retracement would be moving from 200 to 150. Now we can set a minimum or a maximum on a retracement. So for example, we could say the minimum level to qualify for a retracement is 33%. The maximum would be 67%. That's 1/3 and 2/3. We can set these numbers differently as well. Later on in the course, we'll talk about Fibonacci ratios as one way to set these numbers. But let's for now go with what we have here. Let's go with 1/3 and 2/3. And what we can essentially know from this is that if the price reversal is greater than the maximum retracement, alright, so let's say we have price going up and then it retraces by more than the maximum, so by more than 2/3, right, that will be a signal that the original trend is no longer intact. So that will be a signal that what we had is not an intermediate correction, but actually a new trend, right, a new downward trend, for example, right? So in order to qualify for a correction, we need to have a minimum 33% retracement and not more than 67% retracement. If we have more than retracement of 2/3, then we say this is actually a new trend rather than a correction in the existing trend. And this is how we use retracements and what they're useful for. Alright, so now again we'll go back to the example and see what it looks like. Retracements. Again, here we are back on our graph of the Nifty index. Now what we're going to do is just show an example of where we can spot these retracements. In general, retracements are a little bit easier to calculate with an Excel sheet often, and a lot of technical charting software can draw a retracement line for you. But let's just look at it to kind of explain, to understand what's going on. So let's say, for example, we start over here. Okay, we have this downtrend here, and then we have this retracement upward here. Right, so the move from here to here, right, this upward move may represent roughly just over 1/3 of this downward move. So that will be a 1/3 retracement in the move, right? And this one here, for example, would be roughly 2/3 of that, so the maximum kind of retracement of that move before we could say the trend has changed, right? So retracements, we can look at them across the spectrum. It's a bit hard for us to draw it here because we don't necessarily have the actual values calculated, but what you can do is if you do go to the NSE website, then you can actually have them draw a 50% retracement line, a 2/3 retracement line, or a 1/3 retracement line, however you like. And usually the way we will do it is by looking at, you need 2 points to draw the retracement line, right? So you need the original trend point, maybe that's here to here, and then you need the retracement line, which will be drawn along that. So one of the things I want to kind of recommend is that it would be a good idea to go ahead and try and do these things on your own. So all the graphs that we've gone through, it would be a good idea to try and replicate them and try and use some different data. So don't take the Nifty index over 2011, take maybe the Sensex index, or take another, or a particular stock or commodity or an index from a different time period. You can do it how you like, but it's a good idea to kind of practice these concepts for yourself so that you understand them and that you're comfortable working with them.